My street critique guest tonight is Mr. Stan Weinstein, editor and publisher of the widely followed professional tape reader Market Letter.
You have to have good tactics out there for investing, because if you listen to the indicators and you lightened up, and if you had stop losses on your stocks, you were taken out and you avoided this.
The game never changes. They put different costumes on, in different plays, but the concepts are the same.
Can you assure us that we will eventually come out of this?
Oh, come on, like night follows day. There's always another bull market after every bear market and vice versa.
All right, welcome back everybody to the TraderLion conference. It's my honor to introduce our next speaker. He needs no introduction, but of course we've got Stan Weinstein, the author of Secrets for Profiting in Bull and Bear Markets. If you haven't read this yet, I don't know what you've been doing. It's always a pleasure talking with Stan and getting the perspective of a market legend. We'll be covering a ton today, from kind of timeless stage analysis principles, also all the way up until current markets. Stan, thank you so much for being here, and yeah, looking forward to this.
Rich, it's my pleasure. I'm glad to be able to work with you once again. I think that this is such a propitious time for us to be talking, because I've been playing this game for a long time, and I'm not going to BS anybody. This is one of the most trickiest and challenging markets that I've seen. But I think if we follow some discipline for the people that are working with you, it'll be a little less challenging.
Perfect. Why don't we actually start there? I'd love to hear your current take on the market. Where do you think we are? And I asked for questions on Twitter for people that they want to ask you, and they kind of put it in terms of an analogy, which I know you love. What inning of this bull market do you think we're currently in? So I'd love to hear your thoughts on the market and kind of where that stands.
You've just asked about 6 great questions, so here we go. Number one, I think you're in the late innings, 8th inning, whatever, but it doesn't matter. What I want to get across to all your followers today is that, which I've been writing to my clients for the past several weeks, what's much, much more important than worrying just about the market. And I think we're still in the late stages of bull market, but this is one of the most diverse split tapes. And we're going to show them that that's not just words, that's reality that I've seen in my many, many years of market analysis. And if you only talk about the market, I think you're missing it here, because it sounds ridiculous, but what I've been writing is what's good is good and what's bad is bad. And we're going to show them today how to determine what really is good and what they should stay far away from, because there are some markets, like when you came off the bottom, for argument's sake, back in early 2009, after that bear market was over, you could have thrown a dart A to Z, and some were obviously better than others, but almost everything went up. This is a very different animal that we're talking about. So it's a split market. So even though, yes, you're still in a bull market, that's not what's going to put dollars and cents in their pocket. What's going to put money in their pocket is buying good, technically healthy stage 1 and 2 stocks, especially in positive groups. At the same time, staying far away from things that are rolling over. And you're going to see, because there's amazing things going on in this tape that's even amazing me after the many, many years that I've been playing this game.
Perfect. And yeah, like you said, we're going to cover a lot of charts today, both favorable and unfavorable. That'll be great. But first, take a step back. You say we're kind of in the later throes of things now, later innings. Where did kind of the bull market start when it comes to stage analysis? When did that kind of, come to pass?
As usual, a great question. First, if you take very long cycle, I would say it really started in early 2020, but you had that bear market, which happily we were on gear with, from that January of 2022 into that October bottom. So that was really a bear market. So if you're looking at shorter, I should say not shorter, but intermediate term, I think the next stage 2 was from that bottom October, November of 2022 onward. Yeah, I think that's the most important thing to get across. But just again, don't just worry about the market.
Right. And some of the stocks that have had the tremendous moves during this most recent bull market, some of the strongest groups have been AI related, semiconductors. Those have kind of rolled over a little bit, at least in the past few weeks. What's kind of your take on that group and that theme as a whole?
Well, that's an important reality to be aware of, and that's an important rotation that I'm happy that we caught. I'm very proud of a lot of calls I've made over the years, but this intermediate call, we put it out on July 11th into our clients. We said, in fact, for some of the older readers who are more my age, they'll understand this. We use the analogy, we said, it's like the old Bob Dylan song, the times they are a-changing. And up until that point, we had been very bullish, like you just said, on semis and tech and the Magnificent Seven, yada, yada. And a lot of stocks were lagging badly. If you look up to that point, the Russell was really the weak sister. On that day, we made, which I thought was going to be a very important short-term call. I'm not going to lie to you because I always move incrementally, but I felt it was a real important short-term call, which turned out to then become an intermediate-term call, and it may even turn out to be a long-term, but let's not get hung up in terms. On that day, we said, it's a time to sell the Magnificent Seven, the mega big cap stocks, and we thought that, and that's why I used the Bob Dylan analogy song, the times are changing, that a lot of draggy secondary stocks are going to come to the fore. And if you look what's happened since that July 11th date, it's absolutely amazing how many before stocks that had been dragging have come to the fore and are doing great. At the same time, it's been a horror show for a lot of the Microsofts, et cetera, and even NVIDIA is finally becoming an intermediate term problem as it broke below its 50-day moving average. So that call, and again, this is why I hate to get stuck with, bull markets, bear markets. To me, I just care about catching important moves. I feel that was one of the more important moves. And even though they've gotten the mega cap have gotten killed since then, and they're going to have a bounce, obviously. And in fact, it's already started. But the reality is, if you look at your charts, and we'll be looking at a lot of charts today, if you look at your charts, you'll see that almost all of those stocks broke below their respective 50-day moving averages, which to me, and this is something that we have to know and be aware of, in the old days, going back into the 80s, 90s, when stocks broke 50-day, I would sell half positions and often write it out. In this environment, if a stock breaks below and closes cleanly below its 50-day moving average, I blow it out. You can always come back. I'd rather be whipsawed, but things are so violent in this environment. That's one of the few things that's changed. In fact, people always say to me, Stan, does your methodology still work? And yes, it does, because supply and demand is always supply and demand. But what has changed is we're dealing with volatility that I've never seen in my many years of tape reading. Take a look just the last 3 days. On Wednesday of this past week, boom, they smashed the market. On Thursday, had a terrific rally, and then before the rally was done, you lost the whole rally and it turned negative. Then on Friday, you had a kick butt rally, boom, it was going up again. It's wild. So anything that breaks the 50-day MA, I don't want any black clouds in my portfolio. I get out. So if you take a look, you'll see all of those issues broke below their 50-day MAs. And even though maybe a couple of months from now, they'll resurrect and will return, for now, my Bob Dylan thesis is working perfectly. Be in gear with the Russell, but obviously at every stock, but especially stocks that I like and in groups that I like building products. That's a good group.
Yeah.
A lot of cyclicals, biotechnology. We have a lot of small biotech stocks that are kicking butt big time. A lot of REITs look terrific. Not all, but the ones we're putting out. A lot of REITs look terrific. The bank stocks have been great for us. Those are good. At the same time, so many, not all, but so many tech stocks have moved into stage 3. And to me, that's the way people always say, how do you know you've moved into stage 3? When it starts to round over and then you break the 50-day MA, it's stage 3. And in these days, I'm not waiting for stage 4. I'm out. But anyway, those who want to stay around should at the minimum sell half their position, breaking and closing below the 50-day MA. And then if they're still in it and it goes below the 200-day, it's time to punt the remainder. So be in those good groups at the same time. I'm really excited about this because I haven't seen such divergent action for a long time, and we're going to go show them today. If you just go and stay away from the many stage 3 and 4 stocks, and we've had some incredible things like we had, I'm going to show tonight, or actually when you see it now, it'll show this morning, Dexcom, DXCM, David X-Ray Charlie Mary. It had a perfect head and shoulder top, which we're going to show later in this interview. And then it blew up. They were disappointing earnings, whatever, I could care less. All I know is, thank God, we weren't long, and I had people who were short it. And, today when it blew up, we covered a lot of the short. So I want all the people to follow the system to understand that while there's never 100%, reality that it's going to always work, only the liars are 100% right. You're going to see the overwhelming majority, I would say probably about 80% of the good stage 1s and 2s have worked out. The very bad 3s and 4s have blown up, and that's been terrific. And in fact, that's another important thing. In my book, I'm proud of it because most people, I remember when I was a young kid, my hair was still black. I remember reading Nicholas Darvis's book about, how I made $2 million in a couple of minutes and da-da-da-da-da. And the reality is, my book is one of the few where I put in a chapter about, hey, everything doesn't always work. And I think that's one of the keys to success. Instead of being stubborn and expecting, it's going to always work, doesn't work, boom, you sell it, you get out. It's like you wait for the next taxi cab to come along.
Perfect. Stan, I think you covered about 50 good points there, but circling back first to, you mentioned the call you made, the kind of turning point in the market. A very common question people that had was, how do you identify the rotation? So could you kind of walk us through your train of thought about what were you noticing that led to your analysis that, there could be some rotation, the Russell, into there, out of the technology mega caps that have been doing so well? What were you kind of looking for to identify that rotation?
That's a really good question too. First of all, it became over-owned. It became so simple. You started to see everybody saying, all you have to do is buy the Magnificent Seven and forget about it. It reminds me of the old days when I was playing back in 1972, going into 1973 with the nifty 50 stocks of that day. And by the way, the game never changes. They put different costumes on, and different players, but the concepts are the same. And in those days, I remember very well, Avon, Polaroid, Xerox. These are one decision, and that was unbelievable. These are one decision stocks. You can only buy them. You never have to sell them. Now that was a screaming contrary opinion, and we know what happened. They crashed, and some of them went bankrupt. Same concept here. Don't get me wrong. I'm not saying that these stocks are going to have that kind of a hit, but it was becoming so obvious and so over-owned that was one thing that worried me. Then if you go back, look at your charts on July 10th and July 11th, you'll see a lot of those go-go stocks had key reversal days. And what we have to talk about, reversal days, whenever you go up and then it comes down, that's always bothersome. But a key reversal day is very worrisome. And my definition of a key reversal day is you make a new high for the move, then you not only decline for the day, but this is a key, you physically close below the low of the prior session, and then you do all this bad action on heavy volume. That was all over the tape on those stocks. So that's a second thing. Then third, common sense, which when I used to be on the seminar circle, which I no longer am, but anyway, I used to say that common sense is a rare commodity on Wall Street. Common sense tells you when you look at those charts, so many of them were so far above their 200-day moving average. That's a little worrisome. And then in addition to that, many of them were even pretty far above their 50-day moving averages. So you already have to get a little bit of a worry in your stomach there. And then, boom, you get that key reversal day. And we said, time to do selling.
I love that. So you're combining a little bit of sentiment, the extension off the 50, off the 200 day, and then the finally kind of price action telling you with the key reversal day. And I already hear the people typing this out in terms of a question. How much extension from the 50-day, 200-day do you consider extended? Or is it more of a judgment call? It depends on the situation.
It's really a judgment call because some stocks aren't as volatile as others. It could be 50%, others 100%. Don't get stuck with rigid numbers. Just look at the chart, and because it's kind of like your own children. They all have personalities. So some chart, when it gets to be 50, 60%, that's the most you've ever seen in the chart. Other charts may go to 100%. But again, I come back to common sense. And what's interesting, we put out that call on July 11th. Now, you may or may not have seen it, but this week, it suddenly dawned, even on the Wall Street Journal, they had an article in there that said, oh, a historic reversal is occurring that nobody saw and that people were surprised about. And I thought it was interesting because they said, hey, the Russell is coming on and the megas are going down. And I said, welcome to the trip 2 weeks later.
There you go. And I actually want to bring up a chart here, which I'll do shortly, because we actually kind of had a similar, I'll bring up NVIDIA. Let me know when you can see that, Stan. But I'll bring up NVIDIA. We had a similar type of key reversal day back here on March 8th, which did ultimately lead to some basing. Here's the recent one that you mentioned back here. This one happened on July 29th. But here, we're similar thing. We're extended off the 50, 200 day. This one just needed a little bit more time to rebuild, rebase before it broke out again. How is this one kind of different from that previous one?
This is great. First of all, you've just shown separating short term from more important intermediate term. Look at that first reversal you're talking about, and I would be uncomfortable. I would for sure have been doing some reducing there. But look where you are in terms of your moving averages. And look at that, the moving averages are still at that point. Let me just see if I can move it off my screen here because it's covering the chart. Oh, yeah.
Drag it. Yeah.
Good. Okay, here we go. If you take a look at that first reversal you're talking about, you were not only well above the 200-day. What is that? Is that the 50-day, the second one?
This is the 50-day here.
Yeah,
and this
you were well above the 50-day, and the 50-day was still heading clearly north. So that was less concerning. Now let's go to the more recent one. First, again, and this is why everybody should learn to move incrementally, because only the liars at the top tick knows, oh, that's going to be the end of the move. But you take a look first, you do some incremental reducing because you have that key reversal day. Then take a look how it then came down, and now show them the next rally. The next rally failed not only to go to a new high, but it didn't even get back to that prior high where you had the key reversal day. So that's, I'm a little more concerned that it sells off again with another key reversal day there, as it makes a temporary little high and then lower. Now, I had clients, some of them still wanted to stay with the NVIDIA, so I just did some trimming. Now look at the last few days, because this was the last one to go. Everybody loved it, but you see, even here, which was the old holdout, it finally broke below and closed below that. I remember now, I told them the level was 116. It broke and closed below that 116 level. And now, interestingly enough, and this is short-term talk, but interesting enough, look at the good rallies on Thursday and Friday of this week. With the market going bonkers short term on the upside, neither day took NVIDIA back above its 50-day moving average. And the same thing, by the way, happened also. If you look at the Qs, they also failed to move above the 50. Can we get a chart of the Qs up with 50-day moving average?
Yep, here's the Qs right here. Perfect.
That's the Qs?
Yep, this is the Qs.
Beautiful. You're terrific. So anyway, the same thing. Look at how the Qs broke. And now, despite the market on Friday, it had been up over 800 points. I think it closed up like 600 and change. It never got above the 50-day moving average, while a lot of our stage 1 and 2s were kick butt. You can see what's going on. And this is another thing. People say to me nice things over the years. Oh, you're a genius. I'm not a genius. What I am is one of the most disciplined market players that you'll ever meet. I never violate my rules. And once in a while, we all get whipsawed. That's part of the game. Just like, again, using my analogy, if you're playing blackjack and you say, oh, you've got 11, the dealer's got a 6, you don't one day say, I'm not going to double down. Another day you do that. You always double down. And once in a while, you're going to lose. But if you're consistent, and that's what's important, be consistent. If you're consistent and always do that, over time, you're going to be a winner with that. Well, it's the same way here. It can always possibly be a false breakdown, but I don't wait around. To me, whenever you do it, and show them here on the Qs, if you look 1, 2, 3, go back 4 days, Richard, see that?
Right here. Yep.
You had a downside gap from the 4th day to the 3rd day. Look at that. That makes it even worse. It would have been good no matter what, breaking the 50-day, but you've got 2 gaps here. Show them the gap before that. Yeah, or you're right on top of your game. First, you have a gap there. Then you have a second gap on the day, that was on Wednesday, that it broke the 50-day MA. Again, I don't want to be a wise guy and say, oh, you know, it's so easy, but it's so damn obvious. To me, it's, you know, if you learn to play the game right, it's truly as straightforward as in blackjack. Right now, you've got 11 and the dealer's got 6. There's nothing to think about. And you don't get these opportunities that often. So that's what it's about. And it's another important thing. People always say to me, what is another secret to the market? And I know some people get upset when I liken the market to blackjack. But the reality is, obviously, you know, there's, you know, difference intellectually, but there really is similarity, because in both cases, it's following good discipline. And in both cases, it's money management. When you have a really good hand, you got to play it hard. And it's the same thing in the market. When the deck is rich and things are rocking and rolling, you got to play hard. Conversely, when you say, oh, there aren't many, that's the market talking to us. There aren't many stocks that really look good. And interestingly enough, until that call a few weeks ago, even though we were in the mega stuff until we sold it out, a lot of stocks were dragging. And if you take a look, a lot of stocks were really going down throughout that rally, but everything flipped at that Bob Dylan changing times, okay? At that point, it's now I see a lot of stuff forming stage 1 bases in the groups I'm talking about, and there's been tremendous secondary appreciation there. Well, look at this. If you're just riding, oh, I love the Qs and I love, you know, Microsoft or whatever, it's been painful.
Yeah, and it's funny you mentioned the gaps, because that was going to be my next question, because this rally kind of started with a gap up, and it shows the power off the bottom here. And I know you've said before, gaps are, you know, it shows that there's a tiger in the tank and there's a lot of power, a lot of sentiment. And then we actually had another gap here, which led to kind of the last third of this rally. But now we've kind of flipped, and the gap downs are to the downside. We're closing near lows on those days. What do kind of gaps up early in the trend signify to you? And also, you know, how closely, as you just mentioned, you pay attention to when the gaps start going to the downside?
You're doing a hell of a job. First, look at that first gap. Where did it happen? right at the 50-day, by the 50-day moving average. So it was positive. And like you said before, I use that analogy, tiger in the tank, boom. You also had some good volume there.
Yep.
Then you had the second gap after it came down, should go back a little ways, it declined. And look at, these are all hints. The market every day is kind of whispering in our ear, and we have to learn to hear it. It was saying, hey, even though I got hit, the stock, it's not bad. It held a 50-day. Then boom, it broke with on the upside with another upside gap. Boom, terrific. Now, this is important because you've had these two gaps. Now the game suddenly reverses, and it's again that song, the times they are a-changing. You have the gaps on the downside, and if you show them, it's almost like you first have this upside gap, now you have the downside gap. That's a very bearish reversal kind of formation where you can see sentiment about a given stock or index is changing. So we have to be ready to change too. And this is another thing. Like I say, the concepts that I wrote about in my book, which was way back in 1987, many a day ago, is still the same, but they're playing the game so much faster. It's unbelievable. So you still have to know your good discipline, but now it's more challenging because you should never be sloppy, but you could have been a little slow to go to the dance. Now, if you're slow to go to the dance, they can lock the door and you don't get in.
Perfect. And one follow-up question I had on gaps is, say back in this area before the large key reversal day on the 11th, if we gapped up in the morning, we're kind of later in this intermediate term trend. And then, if that happens, it's not for sure as positive as it happens back down here near the 50-day as we're just starting the move. After how many gaps are you getting a little bit cautious in terms of the intermediate trend, if you get my meaning?
That's another great question. I wouldn't say it's the number of gaps, but later in the move, when you see a gap, it may start to become an exhaustion gap. Now, how will we know that? You won't initially know it. You see a gap and it goes up, you say, hooray. But then, if after that gap, it quickly reverses to the downside, or even worse, if you gap up late in the move and then you gap down, which is kind of happening here, although not in your exact example, but if that happens, that is even worse than what we're seeing here. That to me is a sign of an exhaustion blow-off gap.
Perfect.
Now you talk for a minute while I take a drink.
Yeah, sounds good. So hopefully everybody, you guys are enjoying this. Please leave a like for Stan down below. Stan, kind of pivoting a little bit to again back to current markets. Where do you think we stand right now on the Qs? What are some kind of expectations that you might have? Obviously, price action will dictate, and I can also bring up a chart of the IWM, the Russell, whatever you'd like me to bring up.
Sure. First of all, I think the Qs are now early stage 3. Again, don't get crazy about rating everything, but I stuck my neck out. I wrote recently that I think that you've seen the high for this cycle for the Qs, a lot of the go-go stocks, but you don't suddenly go from the penthouse to the outhouse and move into stage 4 overnight. There are going to be people that still want to do bargain hunting. Stocks have to be distributed. So I think that's all I can ever deal with in probabilities. The probability is very strong that was the high for the next several months. And remember, I'm not talking forever. The same way when we happily caught the bear market from January of 22 into the October bottom, it was terrible. But after that, we then started another bull move, and that could happen in the Qs 6-9 months from now. But I'm not going to wait around. You have to play each of these important moves as is. So I think for now, you're in stage 3. But now let's show them mirror image. Let's show them the Russell, what's starting to take place there.
And let me delete this. There you go. Here's the Russell. And it all started with this gap here, and you actually had a secondary gap right here and actually here. So it's really strong power off these lows.
Right. Now that's great. And just look at that. Since that call on July 11th, and you, again, going back to your earlier question, it was a synthesized of several things coming together, that you had those key reversal days on the mega stuff, but at the same time, look at the upside gap here. Look at the volume starting to build up in the Russell there. You are getting the mirror image. So again, I don't want to be facile and say, oh, it's so easy, but you know what? It really was straightforward and kind of obvious. If you learn to hear what the market is whispering to us, it was telling us at that point, hey, the draggy stocks that everybody's hated, they're going to come alive. The go-go stuff that everybody's in is going to become a problem. Again, common sense and discipline, those are keys to making money in the market. And it amazes me to this day, after all the times I'm playing in the market, it's a long time, that so many sophisticated players, hedge funds running a lot of money, don't do some of the obvious moves because they're so tied in to their fundamentals and it doesn't make sense. Oh, wait a second, but these stocks don't have good earnings, whatever. They'll come up with all kinds of excuses, and I don't care about it. But when I get concerned is when suddenly, maybe several months from now, some clients who haven't, happily, many clients are in gear with me, but some client who's not in gear with me will come and say, give me your 3 best Russell stocks. That'll put a bad feeling in my stomach.
Right, exactly. And you sent over a list of stocks that you want to go through. Would you like to start with the favorable or unfavorable?
Yeah, I really would, because this, to me, as far as I'm concerned, Rich, talk is cheap. I've been to so many conferences, and you can walk away and people hear speaker after speaker talking about this and that, whatever. And really, if you say, what have you learned that can really put dollars and cents into your pocket and real points on the scoreboard? What we're going to do now, I honestly believe, if people do their homework with us, it's going to put tremendous potential points in their pocket in the months ahead. So let's go through this, because this is really what we did in our TraderLion teaching course I did with you guys many months ago. This is so important, and it fits in with that old BS phrase that, you give a man a fish, you feed him for today, teach him to fish, it's forever. Let's teach him now. So here we go. And obviously, this is my ballywick, and this is what I believe in. And it's always important to always buy stage 1 and 2, never buy 3 and 4. But I'm telling you now, it's even more important in this environment because things are moving with such volatility. So let's go through, and here we go, and see some stocks. And again, before I show how many of these work, the 1s and 2s that went up, and the 3s and 4s that went down, and how brilliant we are, I want to first emphasize that only the liars are always right. Like I told you before, that's why I put a chapter in my book where I showed, hey, sometimes it doesn't work, and this is how you deal with when it doesn't work. And in fact, I remember it was many a day ago writing the sentence saying, how you deal with a losing position will make you a winner in the market. It sounds counterintuitive, but it really isn't, because I've seen some really smart market players that I deal with will have a lot of winners, but then they'll buy XYZ, let's say at 50.
Right.
And it drops to 42, where maybe it's breaking its moving average and it should be gone. And sometimes ego gets in the way, and they'll average down and they'll figure, hey, if it was a good buy at 50, it's a better buy at 42. And then when it goes to 32, you find out it wasn't. To me, this is so important. So here we go. First chart we should have is error cap. Do we have the AER?
Yep, that's what's on the screen right here. We've
Good,
got the
okay.
breakout back here and the great trend above the 50-day.
I got to tell you, you're so efficient. You're just like my helpers here in the office, my staff. You're fantastic. So take a look. You'll see how it came out of that base pattern way back when. You see there, and you see the volume came in, and it came out of the stage 1 base. It gapped up. It started the stage 2 move, and it's been beautiful. Now it looks like it may be rolling over a little. If it breaks the 50-day MA, I wouldn't short it, but I'd start to do some selling. But take a look, and we look one after the other. Next, let's take a look at Carpenter Technology, good old CRS.
And let me know if you'd like me to zoom in on any part or point out any
I will.
points I'm missing.
Show back here where it came out of the base pattern. Right, that's it. You came out, again, the volume picked up. Not a coincidence. It did its thing. And take a look, even though after the good move, it edged below the show where it edged below the 50-day moving averages, but it never closed there. These are subtleties I want to teach today. Number one, the 50-day was still moving up, so we give it a little more, leeway. Number two, it didn't close cleanly below it, and it's still working. So these are all subtleties. Look how beautiful that move was. Next, let's go.
Stan, could I ask a follow-up question on this one? Sorry, could I ask a follow-up question here?
Sure.
So this one is actually a really good example. It broke out through this pivot here. It broke out on good volume. And then could you walk us through kind of this textbook retest of that breakout point? Because this is a really good example. You've got a great pullback buy opportunity here on April, that would be 16th, where it pulls back right to the pivot, then closes really strong. So if it'd be great to see you kind of walk through that price action there.
Absolutely. I got to tell you, you're doing as good a job as me at teaching. Go look, go back a little to your left, and you had a little baby gap. You see that upside gap right there? Yep. And not coincidentally, when it came down, look, it didn't even cover the gap. By the way, that's another thing. A lot of books are written that gaps have to be covered, whatever. I would say probably 80-85% of gaps do get covered. But the 10 or 15% of gaps on the upside gaps that don't get covered, that's tiger in the tank. And not coincidentally, it held there and then it took off again. And then look, you had another breakaway gap after that.
Yep, perfect.
Right? Very, very good. Let's next move on to Emergent Bio, EBS.
Yep, we're right there.
Again, look at pattern after pattern. You had that move into stage 2 above the 200-day MA. You had a huge upside gap. Look at the volume there. You had tremendous volume, and the rest is history.
And for this one, are you looking to buy right as it pushes through the 200-day moving average?
Yes.
Yeah.
Yes. And there, I'll be honest, we only got a half position because I figured it moved so sharply. So we bought the first half, just what you rightly said, but I thought there would be a retest, just like you saw in the prior one. This stock was so strong, it didn't give you a chance to retest, but hey, a half a loaf of bread is better than none.
And just to follow up there, if you had bought at the 200-day and it progressed that day, but then the next day, started undercutting lows and pulling back, at what point would you cut that loss? As you said, it's how we deal with losing positions that makes us a winner over the long term.
100%.
So you start cutting under this low?
I'm sorry, what?
I was just going to follow up there. So you'd start cutting. If it undercuts those lows, that's when you start to think about trimming?
Yeah, if it undercut the lows, but it didn't.
Yes, yes.
Next, let's go, Rich, to Golar GLNG.
Yep, there we are.
Again, and you'll see, it's almost becoming repetitive. Take a look. so many of these that work. It's not just an accident. I love when people think that, I've read some articles where people, do these professors that say technical analysis is no different than Nancy Reagan astrology. And I laughed to myself. You take a look, how coincidental is it that every one of these patterns exploded on the upside? And that's why I want to do more in this, interview today than just simply talk words. I want to talk patterns, because if all the people who are watching with us can get it, it's kind of like, again, I'm talking in analogous form, like I'm hitting tennis balls to you and you're practicing your ground strokes. The more balls I hit you left and right, the better you get. Look at this. Again, look, show them where it broke out, show them the fact that it had the breakaway gap, did it on good volume. Look, after several months of run, look at how it tested its 50-day MA. And it's still onward and upward. Again, it's beautiful. So when people can learn proper, which I try to do, and people that I've worked with really have learned that some of us that have changed their lives. When you learn proper pattern recognition, it becomes second nature to you. And I want to get it across to everybody today to see the proper pattern you should be looking for, that it becomes second nature, that it becomes like you've got 11, the dealer's got 6. Go for it. Don't stop and say, oh, gee, I don't know. Maybe this isn't a good company, whatever. If the market talks and says it is, we're doing it, and that's it.
And Stan, one follow-up question. A lot of viewers were asking about, what makes a prime setup for a stage 2 breakout? What kind of characteristics in terms of price and volume are you looking for to potentially say, okay, we're ready for a transition from stage 1 to stage 2A?
I think you've answered it, and we'll do more of this by the patterns we're showing them. Mm-hmm. Rather than words, just look for a base. And I always say, the bigger the base, it's like putting a foundation under your house. So a nice base, look how it came down there before it broke out, and it tested the prior low from several months ago. You had a nice big base. Then once it went above the 200-day, again, not a coincidence, breakaway gap. Look at the gap. You moved into stage 2. I think that it's kind of clear.
Perfect. All right. Next up.
All right, let's move ahead next to a favorite of Alphabet.
Yep, there we are.
Now, this is a little trickier because it's had, wiggles and jiggles along the way. So it isn't as clean as some of the others, but if you take a look at the recent move over here, yeah, you got it. That's perfect. While the others were much easier and cleaner, this Google, a lot of people like to play, so that's why I put it in here. First look how you had the upside gap. Next, look when it corrected several weeks thereafter, look how it held nicely above the 50-day MA. Then look how you had another upside gap. And then look how you ran to the top. Now, this is a better example. The others were good, long-term, clean. This is a better intermediate trade, but I wanted to put it in here because I get asked so often about Google, and now people ask me, why do you think, and have you written, that you think Google has seen an important high? And I want us all to agree. I don't want it to be Stan pontificating. I want you to look at the probability and say, hey, first, look how it gapped down. And where did it do the gap? By the 50-day moving average. And also, group action is important. If it was just Google, it would bother me. When it's Google and all of its cousins, it bothers me more.
Perfect. And huge volume coming in to the downside through the 50-day.
Right. And that's, you can also, because we're doing so much here today, look where, again, we're playing a probability game. Where are the probabilities favoring that in the next couple of weeks we get a rally that'll rally to? I think it's rallying right, you got it, right up to that area, which is the confluence of the gap and the 50-day moving average. But of course, to those Ivy League professors, it'll just be a coincidence when it fails there.
There you go. All right, here we go. INSG.
Let's go. Yeah, right. Here we go. Now, this was a cheapie guy, but this is a nice percentage move because you'll see it basically doubled. And again, look at how it moved above. Show them where it first moved above the 200-day. Look how when it came down, where did it hold? Right there by the 200-day and the next couple of days thereafter. Oh, and what happened after that? Upside gap. Oh, and it happened on good volume. Do you see, Rich? It's like repetitive. You know, there are certain disciplines that repeat over and over again. And if you can learn the proper pattern recognition, it becomes second nature. And that's what I'd like it to be today, because I see some people will really get it, but then they'll deviate because they'll do it one day, but the next day they'll buy it because their broker tells them, because they read an article in the Wall Street Journal. I want them to become totally disciplined and pattern recognition and become, as I keep saying, 11 versus the dealer 6.
And one thing I do notice here is we've got the first test of the 50-day now, but we've got this lower high as well. So we'll see if it kind of holds this area or we get a waterfall below the 50-day.
That's great. And
Yeah.
and people always say, how will I know when to sell it? Show them right there where they'll know to take their profit, which was a double. If it closes below that double 2-day bottom and the 50-day moving average, I don't care what happens thereafter. I'm history.
There you go. Perfect.
See, and that's the discipline that we want them to get. Let's go on to the next one.
All right, here we are.
Okay, so here we go. And we just went from a real doggy little secondary stock to a good bank, the main guy. And you take a look and look at, again, show them way back where it moved above its 200-day MA. It broke out. This one didn't really have gaps, although later on it had a little gap, you'll see.
It had a little gap here, actually, right
Yeah,
here.
right. And then show them several weeks out. And yeah, you got it. A little gap there. But this was more conservative. We put out all kinds of stuff for conservative investors, for longer term investors, for speculators. So this was a good conservative stock, and it's doing its thing, and it's fine. But you got to watch it. Again, if it breaks cleanly and closes cleanly below the 50-day, I would be out. Moving ahead, now this is a real interesting one. Take a look. Here we go. Again, we got the gap. Look at the little breakaway gap. And it's so interesting how often gaps occur in a positive fashion, breaking above the 200-day MA. And conversely, when things are turning bearish, how often they break 50-day MAs with gaps. That's very important. But anyway, it had a terrific move. And later on, you had another gap. You can show them many, many, many weeks later, another gap. And then even though when you came down to that 50-day moving average, it didn't close below it. Now it did close below it, and we're out of it. And this is bothering me because you're starting to see, and this is what I think the system is showing how important it is. They're really separating the wheat from the chaff here. And this is why when we first started this conversation, I said, I don't even want to talk about you're in a bull market. There's some great stuff. There's a lot of things that I use the phrase termites are at work beneath the surface, which happens often in the 8th inning of a bull market. I think termites are at work. So we still have some houses that are fine, but there are others where the floors are getting a little weak. And if we're not careful, they could collapse.
Excellent. All right. On to the
Okay, let's
next.
move ahead.
All right, here we are with SLQT.
Right. Again, let's take a look. Here we go. You broke out again, and it was beautiful. Look about what you said before about the retest.
Yep, right there.
Look at that retest. And again, people who really don't understand technical analysis think these things are just coincidence. Oh, it's just a coincidence that it held an inch above its 200-day MA. And then look at the terrific move that came thereafter, even with a little gap.
Yep, right here.
In fact, two little gaps there. And then when it had its next significant correction, look at how it held at the 50-day MA. And here we go.
And I love the volume coming in after this retest. So much
Exactly.
larger than this pullback. Yep.
Exactly. And look, by the way, when it came off of that first high, which was back in, no, I'm sorry, the second high, make the second high, and it broke the 50-day MA.
Mm-hmm.
Look at how at that point the volume actually contracted throughout that correction. And then look at how the volume increased when it got going again. Those are all positive signals.
And that was actually a question that some people had, Stan. Has your interpretation of volume changed at all with, dark pools, high frequency trading? Is that at all changed your perspective on how to interpret volume, or not much?
Not really. I think you can overthink things. And to me, I'm a simple pragmatist, and I'm going to always go with the pattern. But there's no doubt that what you're saying, games are being played and whatever. And that's why, I mean, you're a youngin', but I'm sure even you're surprised in your career, some of the moves you've seen recently compared to 5, 6, 7 years ago. And I'm telling you, compared to 30, 40 years ago, you would have never seen this kind of moves. But our job isn't to bitch and moan. Our job is to, okay, this is the way it is. How do we deal with it?
Love that. Perfect. All right. We've got THK. Here's the break
Again,
above the
and I
200.
know, look at this, and I'm doing this purposely, being repetitive to show people what to look for, because I'm asked so often about, oh, what should you look for an ideal stage 2 buy? I'm showing you time after time. Show it to them. You had the base. And before even it breaks out, Rich, show them how the second decline was above the first decline. Show them that disparity. Good. And then when you break out, let's show them the volume coming in. Oh, just a coincidence. And then let's look at the little gap that happened there. Oh, and another coincidence, when it comes down, look how it just coincidentally held above the darn gap.
And then held the 50 multiple times.
Right. And note that even when it broke the 50-day was still rising. So we'll give it a little bit more leeway. And boom, it quickly the next day was back above it. And then the next time it broke the 50, show them the next time it broke the 50. It didn't even close below the 50. But here's where, again, the times they are changing. Now the 50 is starting to lose altitude, and it's starting to go sideways. So you got to be a little bit more paranoid and a little bit less forgiving. And oh, now you've closed below it and we're out.
Mm-hmm. All right, we've got TPC, and let me know at any time if you'd like to jump to the unfavorable charts.
Fine, let's, I think we've done enough good stuff.
Yeah.
Now let's get them going on. And this is what I think is so exciting. Let's go to the negative stocks, because this is happening. It isn't like I'm going back to like 2022 and finding pictures. I'm showing here and now as the market's hitting the market. It's hitting new all-time highs. And meantime, I want to show the devastation that's going on if a person thinks like, well, I'm in a bull market, so I'm sure the market will bail me out. You're so far past that. no way can you stay with the bearish stocks. Let's go and show them.
Yep. Here we've got ASAI.
Right, here we go with ASAI. First, before it breaks down, go and trace out for them, Rich, the stage 3 distribution, the potential stage 3. Now, people ask me, this is another question I get, when it's starting to roll and it's in stage 3, can it go back into stage 2? Yes, it can. I would say maybe 10 or 15% of the cases. But if that happens, it's got to break out again and cleanly get out of there. This didn't get out of there, and instead show them now the downside gap. Go back a little to the left, a little more to the left, right there.
Yep.
First, you make, now these are all good teaching materials. First, on that day, you make a new high. And while it wasn't a key reversal because it didn't close below the prior low, okay, but still it was a reversal day. I'm a little concerned because you make a new high and you close down. Then the next day, I get an even worse feeling in my stomach because you get a downside gap. Then later in the day, it becomes even more worrisome because you break below the 50-day moving average. And while all this is going on, the 50-day moving average is going sideways.
Right.
Then it really hits the fan. Show them now the next downside gap. Yep. Now you get a downside gap below the 50-day. Then you get a second downside gap. And you're now breaking not only the 50, below the 50, but the 200. Now look, so you should be out of it, but look what happens in the next several weeks. The rallies all fail near the 200-day. And if you're looking to do shorting, once it broke, make a little, like a trend line, not down, but that's it, straight, that's it. Right across, that was a beautiful, beautiful breaking of the floor. And look how it got hit.
And would that be where you're looking to build a short position at this point as it's breaking? Yep.
That's a great initiation. Or if you've already gotten in it, you'd press your bet there.
Perfect. All right, we've got the next one,
All right.
BLMN.
Next, let's go to Bloomin'.
Yep.
And again, these things just don't come out of thin air. If anybody really is doing their proper homework today, they are learning what I think is the most important lesson in the market, which I keep coming back to, pattern recognition. Look at how we showed them all of those stage 1 bases that broke out and became stage 2. We had a lot of winners. Look at it now, show them, Rich, because I know you know this stuff, show them how it rolled over for quite a while. And I used to say when I was on a seminar circuit, the bigger the top, the bigger the drop. Look at how it rolled long-term for so long. And then now, I like that, how you're squeezing it. Now look at, you got that little head and shoulders action. You got it in there. Then boom, you break the 200-day moving average, and the rest is beautiful history. It was a good short.
Yep, and I like you've got a little bounce off the 50-day, and then finally you break below the 50-day before you go tight for a little bit and reconfirm to the downside. This would have been a good short spot as well, breaking below the 200-day and this little shelf.
Right, now I'm going to show you, we're doing so many things here. Go to present day now. This fits in. Now, I don't want to confuse people because this is still not a good long-term buy, but we've covered the short, and I call a stock that after it's gotten killed, that if it then makes a little baby base and then moves above the 50-day moving average, I call it stage 4B minus. A normal 4B, B just means you're late in the move. So a 4B is late in the move, but a 4B minus means the minus means it's no longer a good 4B. And it actually can become a trading, hear what I'm saying, a trading buy. And if this is on the 1 yard line right now. If it goes above and close above that high of 4 days ago, while I don't like it as a long-term stage one buy for my traders, I do think it's a good 4B minus play that could jam back to the 200-day moving average. So I think we're doing so many things here today. And this is another thing, the same way. Let's think about this. We see so many Googles and NVIDIAs that were great that are rolling over and going into stage three. And at the same time, here's a perfect example. We see a lot of secondary junk actually making little bases and getting ready to have rallies, contra-trend rallies. It becomes so clear where I think the next 4, 6, 8 weeks is going to be played.
And I think, I'm not sure if it was last year or in the masterclass that you used Netflix as an example of a 4B minus, but I'll go to that very, very quickly and we'll be right back here. But way back before this huge rally, we have Netflix, which got absolutely destroyed. And then here's the break above the 50, which ultimately started the uptrend. And then it started another stage 2 out here. But just want to bring that up really quickly. Stan, anything to add here, or you want to go back to the list? I just want to point out this example.
That's so great on your part. And this is, again, fits in when I talk about incrementally. Traders would play each of those moves separately, but an investor who is willing to be early could say, fine, I'll start out trading Netflix right there at the 4B minus. And then when it gets the upside gap and it starts, they can actually start becoming more serious. But it took a long time for the 4B minus before it became a stage 2. And it was a sloppy move along the way. But anyway, that was very good on your part.
Yep. And now we're back to D-Lo.
So, here we go. Same song, different verse. Show them again how the distribution, it went sideways, it couldn't go to new highs. Again, look at how, before it broke down, it showed them that day, right? Go right on the gap down day, right there. Now go up the one day before. It has that little phony breakout on the upside, just short term, and then boom, look at the next day. See, this is what people have to learn. Each day, the market is giving us hints, and some are bigger hints than others. And when you get a hint like that, which, first of all, we haven't liked the stock for months because it's rolling, then you get that little upside jiggle, and then boom, you get the downside gap. The rest is history. They destroyed it. And again, it proved stage 3 into stage 4 how important it is. And this is in the middle of a rip-roaring bull market.
And you had, after the gap down, you had a rally back to the 200-day, 50-day confluence.
And look where it failed.
Yep. Then rejection down. Perfect.
Onward to the next.
DLTR, here we are.
Another one, and this is why I keep emphasizing, Rich, how important gaps are. Now, I'm not going to lie. Go back to the very high there. At that point, only a liar would know that the stock was in trouble. It may take a few chips off because it's extended, but there's no sign. But look at how quickly this stock hit the retro rockets with that big downside gap. And then you got one more chance to get out. Show them how it rallied and again, coincidentally failed right at the 50-day MA. And boom, since then it's been downward and ever moving lower.
And you had another failure at the 200-day here and then another failure at the 50-day right here. So a lot of coincidences.
Oh, there's so many coincidences. Let's go on to the next one.
Yep, EVH.
Okay, here we go. Again, show them this was a little, actually a big head and shoulder. But let's go more recently here. Yeah, that's good. So we don't lose perspective. It looked like the hunchback of Notre Dame because the right shoulder wasn't as big as the left shoulder. So show them the left shoulder, and there's good. Then there's the head, and show them how they got now the right shoulder, which was a baby right shoulder. And once it broke, boom.
So right here, you've got the confluence of this low lining up with the 200-day moving average. And once it breaks that, that's the downside right there.
Exactly. And again, now look, I don't want to buy this, but take a look how after getting creamed, it's moved above its 50-day MA. It's got a little 4B minus play coming. This again reinforces that it's going to be almost biblical. A lot of bad is going to be good, and a lot good is going to be bad. So it's almost going to be like the old Bible thing. Those that are first will be last, and those that are last will be first.
And you even have a little baby gap here after close below the 200-day. The next day, you've got a baby gap down. And of course, you've got the other gap down.
Right, and then a little baby gap there.
Yep, exactly.
On to the next guy.
Yep, here's 5.
All right, now take a look. Again, pattern recognition. You had that double top, but again, shown before it broke. You couldn't have known it was stage 2B. B, remember, is late in any phase. So 2B is late in the move, but it's still bullish. Suddenly, and this is why you have to be on top of your game, look at how you suddenly got that downside gap, just like the DLTR did. You got that downside gap immediately. You shouldn't fool around. You got to say, something is changing. They're hitting the retro rockets. Boom, get out. And if you want a short, it's a short. And look at how the next little rally coincidentally failed right where it should have at the 200-day MA.
And this one actually, if it had gapped up, instead of gapping down, if it had gapped up on big volume, you've got to pivot here. Would that kind of been a resumption of a stage 2 uptrend?
Yes.
Yep.
Yes. That's why, great on your part. And that's why you have to be flexible. And this is what, another thing, forget fundamentalists have no sense of timing. But in addition, they get wedded to a thesis. If you're really, really doing your job, you just did a great thing. You've got to be, I mean, sometimes it's obvious, you got a head and shoulder top, whatever. But there are other times you've got to be somewhat agnostic, and you've got to say, hey, I'm ready to go either way, and the market's going to talk, and I'm going to listen. That's a beautiful point you got across.
Perfect. All right, the next one we've got Fresh, FRSH.
Again, I'm going to let you walk them through it. Look at how you first, let's go more recent vintage. Good, that's good. First, you have 1, 2, 3 lower lows. That's a little bothersome. Then you have the 50-day flattening out. Then you break in the 50-day, I'm out of it. Then you break the 200-day and look, a little downside gap. Then even when you get a rally several weeks hence, it fails right at the declining 50-day MA. Boom, it gets killed. Now, another piece of you-know-what is starting to make short-term base. And this is why people don't get, like they'll think like, oh, it's just magic that, we caught that, Bob Dylan reversal, changing times. No, you take a look, you can see so many stocks that were bad, or at least shorter term starting to shape up, and so many stocks that were good, at least short, intermediate term is shaping down. The market is telegraphing the strong probability of what the coming months are likely to be.
Perfect. All right, next up we've got FWRG.
Right? Again, this is show them first you have the double top. Then you have that little baby downside gap. And you break the 50-day moving average. Then you break the 200-day moving average. Then the rally fails coincidentally at the 200-day moving average. Then it gets even worse.
Perfect.
All of these, just like when you're playing poker, they say, you play according to Hoyle. All of these are going according to Hoyle.
There we go. And do you want to do some kind of rapid fire tennis balls since we've been going an hour
Sure.
15
I
now?
think that we've got across that. Let's do one more. Oh, did we do that? I wanted to do that DXCM. Did we do DXCM?
Yep, I'll bring that up. There we go.
Yeah, look at this. I think this is a thing of beauty, a joy to behold. Look at it. First, show them the major rolling top. Then, first you broke the 50-day, and it's a big rolling top, and you've got a top within a top. Then when you broke the 200-day MA, terrible. And meanwhile, some people are still going to be in the stock. And then suddenly, in today's trading, they were disappointed. Who knows? The earnings, whatever, were bad. And look at the stock blew up and lost 30% in one day. And people think these things come from nowhere. You know what? Somebody knows. Inside the company, somebody knows. And stock was distributed. And now, once the news came out, the Dexcom blew up big time. So that proves you should never hold a crummy chart, and you should never short a bullish one, no matter what you think fundamentally. Now let's go because it's getting late into this interview, so let's take any questions you have.
Yeah, I just have a few closing ones. First of all, Stan, thank you for walking through the charts. I think, like you said, it's great to train their chart eyes with all those reps. I thought this was an excellent question that somebody submitted. If you could add one new chapter to your book, what would it be? I don't know if you've thought about that before, but I don't know if you have any ideas there, but I'm sure, with changing markets, there might be something you'd want to add.
That's a great question. First of all, they came to me and asked me to write another book, and I said, no, that was my contribution to literature. It took a year out of my and my wife Rita's life, never doing it again. So that was that. And the concepts are still the same. But if I was to add another chapter, it would be, which we actually alluded to earlier, that with the game now so fast, the volatility so ridiculous, I'd said before, whereas in the old days, I would only maybe blow out half a position if it broke the 50-day, that once it had gone sideways, whatever. You got to be faster in this market. So it would be A, be faster. B, if it closes cleanly below the 50-day, especially if the 50-day is no longer rising, get out. Also, be more flexible. And like we spoke about before, to have, move incrementally. When you get, like we did on that July 11th, when you get a key reversal day, don't just look askance at it and say, oh, well, it was just a bad day. Each day should be a move. You shouldn't be, it doesn't happen overnight. You shouldn't be bullish on Monday and bearish on Tuesday. It should be like, hey, on Tuesday, I'm bothered, and I'd start to do some trimming because I had a key reversal day. And then several days later, it breaks the 50-day. Oh, I'm now going to get out of it. So you got to be faster. And I would always say this never changed. If there's one thing you have to learn to do, it's be disciplined. Don't decide this time it's going to be different. I never bet on firsts.
There you go. And another key question that kind of alludes to what you've all been talking about, but what are some of the most important principles to trade successfully over the decades, and maybe more in terms of continue to be disciplined, finding balance between trading and life, which I know you went in depth in the masterclass about everything you do to stay, in top shape and all of that. So maybe in terms of that perspective, what's most important to do this successfully for decades?
I think the market has also become, probably because of ETFs, become much more group oriented. In the old days, I would see some good in a group, some bad in a group. Now, interestingly enough, if a group becomes a problem, almost the whole group, it becomes a sale. If a group becomes good, like we have a lot of biotechs, small biotechs, almost the whole group becomes good. So I would pay much more attention, always did, but I'd pay much more attention than ever to group action and make sure that, let's say you have stock A, it's a good looking chart, but it's in a negative group, and stock B is the same good looking chart, it's in a terrific group, I would definitely overweight the positive group.
And just two more questions here, Stan. This has been excellent. If you had one piece of homework, so you're giving everybody an assignment today. I don't know if you knew that before, but if you had one piece of homework that everybody could do today that would improve them as a trader, and maybe it's taking more reps in terms of tennis balls as we went through, what would you kind of assign them to help them along the right path?
Another great question, and I think we really covered this, and this is why it was my pleasure to work with Richard. I think he did a fabulous job. He always does. I keep using the word pattern recognition. Don't make the game harder than it has to be. I don't want to be simplistic and say, oh, it's easy, but it really, so many people make it more difficult. And I'll watch because, some people will start with so many different things. They'll say, well, you know what? The pattern looks good, but oh, the stochastic is on a sell. But oh, wait, the MACD is on a buy. You know what? There's that old KISS, keep it simple, stupid stuff. I think we want to keep it simple. And if there's one thing I would get across, I took so much time with you all today. Do your homework. We should all agree what looks good, and it wasn't a coincidence that the stocks did well, and what looked lousy, it is not a coincidence they got bombed. Learn your pattern recognition and let the fundamentalists argue night and day, and they'll end up being wrong.
There you go. And Stan, thank you again. Just one last question. Any final piece of advice for everybody watching today? It could be trading related, it could be life related. What are some, words of wisdom that you'd want everybody to take away from this session?
That's a tough one. I would just say, get balance in your life. That's really important, because not only will you be healthier, but in addition, I think it'll make you a better market player if you get away once in a while, especially when the deck isn't rich. There are times you don't want to leave because you feel like you're leaving money on the table. Everything is working, whatever. It's like shooting fish in a barrel. But you got to take some vacations because you get stale after a while. So I think it's important to get a little balance in your life, whether it's playing golf, which I'm not a golfer, but going on vacations, reading a book, taking a walk, just whatever, walking on the beach, just whatever works for you. Get a little bit of balance, because everything is in dollars and cents, and it'll actually end up making you a better market player.
There you go. Well, Stan, it's truly an honor every time I get to chat with you. I never would have thought the first time I got to read your book that I'd be getting to speak with you. The wonders of technology and Zoom, it's so much fun. I'm sure everybody watching this feels exactly the same. So on behalf of all of us, thank you so much for your time.
I got to say, it's truly my pleasure. I love getting across to people and hopefully making you just a little bit better player in the market.
There we go. So thank you again, Stan. Thank you to everybody watching. Hopefully you guys got a ton out of that. I know I'll be rewatching that carefully and taking diligent notes. Yeah, make sure to leave a like down below. Thanks, Stan, in the chat. Stan, do you have one last?
God bless.
God bless. There you go. So everybody take care, and we'll be right back. Cheers.